Victor was gracious enough last night to help underwrite a deal that a partner and I are looking at, and he spent 2.5 hours with us underwriting, very thorough, and I want to make sure his time he's
Which was
here.
helpful to put this together because there was a couple of things that I thought I was missing that we that I added onto the presentation. So
But Ross, yeah, let me post that information, get some more
So
people
we can,
admitted.
how many people are in the mastermind, or you have more than one?
We host there are 20 calls over 20 calls every month in the mastermind, the virtual mastermind, just like this. Matter of fact, Victor is one of the VPs who leads one of those calls, and as the theme that I really haven't told anybody this, but as the week goes on, yesterday are the only two guests that are not current members of the mastermind, the W2 Capitalist Mastermind. So everybody that you're seeing present this week, except for yesterday, just happened to be that it was both yesterday, are members of the mastermind. Victor just happens to be one of those guys who excels in his field and has been in the mastermind long enough to step up into what I call a VP role. And so he leads the mobile home park mastermind call. And we've got 4 or 5 other folks who do the same thing. We've got a single family buy and hold, single family fix and flip, commercial multifamily, and then I run general sessions. And then also we just started up a ladies call out of popular request. Apparently you ladies like to get together and talk and say stuff without us guys around. So there's a ladies call just for that. And then, but yeah, that's it. So that's kind of my very brief answer to your question, Ross, because I really want to turn things over to Victor.
Okay,
Um,
thank you.
you bet. So got a lot of people coming in. We are recording. We're live streaming on YouTube. I'm going to post some stuff in the chat. Victor, I want to hand it over to you. Do you need anything from me right now?
no, I'll just start sharing the screen, kind of go over the, just to kind of keep myself on track, like we talked last night on some points. I'll go over some of the main things for y'all that are joining in, right? Like just go over some of the main things that I see that that I learned, or that a lot of times when we're underwriting mobile home parks, that can have some nuances in there. And then I'm hoping that I can kind of hit all of that and then open up to some Q&A to have you guys just fire questions, and I can answer them as best as I can. So without that being said, so basically the presentation today is about potential pitfalls when underwriting mobile home park investments, right? So MHP is short for mobile home parks. So the important thing, just as you're wanting to get into this industry or learn more about it, is kind of start getting used to the lingo. So a little bit, about me and my significant other, Nina. We've been investing in real estate basically full-time, myself full-time since 2015. We've done a lot of single family fix and flips throughout my career, and then we transitioned into having a property management company. We're invested in mobile home parks, multifamily, and we do single family as well. So we manage and we we also own. So this is a little bit of our portfolio that doesn't include the single family stuff. On the apartments on the top, mobile home parks, and an RV park that we recently bought on the bottom. Just to give a little bit of idea of why I like to start with this is because there's a reason why we really like mobile home parks, and why a lot of people starts gravitating towards this asset class. Number one is a very recession resistant asset class. You're dealing with affordable housing. And so, typically like your vacancy rates and your tenants are in essential businesses, and, they usually, navigate very well. For you to have an idea, mobile home parks and storage units are the number one least default rate. So I hope that made sense. So the asset class in real estate that has the least default in their mortgages, it varies between every year between mobile home parks and storage units. So it's a very good cash flow from day one, right? Unless you're going out there and venturing and developing, which is not what we do, but you start cash flowing day one when you buy the property. So there's always, which is a great thing, right? For investment. Ability to force appreciation. We'll go that a little bit on the underwriting component of it, and increasing of rents and things like that. Reduced and stable operational costs. So there's two models, and I'll jump on this right now because there's two models that people run mobile home parks in. Okay, one is what they call the park-owned home model, which means that it's like vertical apartment complex. You own all the mobile homes and you lease the mobile homes out and rent them out individually. And so it's kind of like an apartment complex model, like a multifamily. And then there's what we do and we like to do, which is the land lease business. So you're just leasing the lots. The tenants own their own mobile home. They're responsible for that. So you're just maintaining. You're like the best version to describe this, you're like an HOA, but you own the land, right? So HOA means collection agency. That's kind of what you are. And so, when you use the land lease model, right, you can operate some of these mobile home parks between like 25 to 35% expense ratios if it's stabilized, a little bit higher if they're smaller. So what we kind of mentioned last night on our call was like, if you're looking at sub 40, you're usually going to operate it between a 35 to 45% expense ratio, depending on the infrastructure of the property. On bigger, you're going to be, let's say 40 to 100, you're like at 30 to 40, and then 100 plus, you can operate at that 30%, sometimes 25, depending on how you manage the property and the infrastructure. So it's really, really low expense ratios, which allows also you, stabilize the property and maintain it pretty well. And then this is kind of the feel good part about it, which is the ability to positively impact affordable housing, right? A lot of times our strategy is value add. So we're buying these properties that either have been treated like a trailer park, right? And we're trying to make it a community, or it has, there's the owners just have been owning them for years and they just kind of ran out of cash to really improve. So they're just maintaining the best they can. And then we're coming in with, which is recapitalizing the park and, improving it to make it, better and improving the quality of living for the folks that are there, right? So it's just kind of what really makes, what I really also like about this industry. And mobile home parks is the only form of non-subsidized housing, affordable housing out there right now in the market, which is pretty cool. So this is just to give you guys an idea. So when you're investing in mobile home parks, you have the marketing to find it. There's several ways. Underwriting, which we're going to be talking about today. Due diligence, we might jump kind of like to get a little bit involved in there because it go hand in hand. Financing, management, and then sale or refinance, depending what your exit strategy is. So, so for today, we're talking about underwriting, right? And so there's three main things that you need to take into consideration when you're underwriting technically anything, but especially mobile home parks. One is, what's your acquisition strategy going to be as far as your overall plan for the property, right? Are you flipping it in a year, buying it really cheap, trying to improve as much as you can, and then sell that thing off in a year? Are you going to be doing a 5-year exit like most apartment complexes you see nowadays? You get in, get out in 5 years, or you're doing a long-term hold with a refi event in the middle. That's kind of what we like. We underwrite it for a 10-year hold, with a 3 to 5 years in between there, we're going to have a cash out event. So we refinance, cash out of the property, and then we should have, our goal is to be 70 to 100% of our initial investment capital refunded back on that 3 to 5 years. And then we have basically a free property, right? At that point. So very important to know that exit strategy, because there's going to be a few things that you're going to be watching out for on your exit cap rates, if you're refinancing your refinance cap rate, and also you can also plan staged improvements from, on that property. So very, very important to understand that component of it. Also, find or create a good underwriting spreadsheet. This is something that,
and Victor has one of the most thorough ones. I think he will give to you for a fee, because
yeah, it's So just to, full disclosure, it cost me, what I did is I've been part of several mobile home park masterminds, and I was, paid the fees to be part of that mastermind, and I got some underwriting spreadsheets from them. Just I didn't feel like I could do everything that I wanted to do under those. So I paid about $2,000 for a guy and myself spending time, creating what I will show you guys a little bit right now to kind of go over some of the details. But that is very important, because in mobile home parks, there's a few nuances that is not
just
normal.
A few.
Yeah. That is not normal when you're underwriting like a multifamily and any other kind of asset class that I see out there. Because, for example, you have a vacant lot, okay? A vacant lot isn't one of the biggest value adds you can have on mobile home parks, right? Because if you find somebody to bring in their home, there you just increase, depending on what your cap rate is for that type of property, you can have a huge bump, and you're not paying a lot or zero for that vacant lot when you're buying, right? Because you're not putting any revenue, there's no any revenue generations there, it's just $0. And then there's also your park owned home. So let's say you buy a vacant house that's there on the property, right? But it's not being rented. So you won't pay for the revenue of that, but you might pay for either the shell value of that home, or you're going to underwrite, they're going to fix it up, and there's going to be your seller finance that, and so you're going to have a revenue stream coming out of that home. And so those are the things that you need to kind of know how to play and understand the nuances whenever you're underwriting these things. Now, I was telling Jamie yesterday, like the first few times you do this, it'll take a while, right? But after you practice and you get familiar with the industry, it should be, a lot smoother. So like I spend, when I'm underwriting a property, full underwriting, right? 30 minutes to about an hour to kind of be able to run a whole property through and make sure that I'm not making any errors and things like that. So, which you will make. So I like this quote also that a big mobile home park investor told me, is that every underwriting pro forma spreadsheet is always wrong. So everything that you're going to see and you're going to pro forma is either going to be better or worse, never the same. So just understand that too. And then most important thing is review the owner's numbers that they give you, and do market research, right? To see, because unlike, let's say, I want to use the example of multifamily or even single family. Single family, you can run comps, you can run rental comps, you can run, sales comps on the MLS, boom, done, super easy. Multifamily, you have CoStar and all these other softwares that you can assist you in doing a CMA of some sort for the property. Now, mobile home parks, we have zero of that, okay? So what you're gonna do is, as you're prospecting, you're trying to get market information, right? So are these things vacant or occupied? How many vacancies they have? What are they renting the lots for? And you're gonna create kind of your own database of that. And after you do that one time, around, you can start seeing the pattern of what the lot rents are. And then you can start setting those out. A good rule of thumb that I usually tell folks, that was an industry kind of standard that people say, look at the 2-bedroom apartment complexes, and divide that rent by half. So divide it by 2, and you should have what your lot rent for that market should be. So that's a rule of thumb. Now, it's not always true, but that's an easy way to also kind of underwrite. Because again, your underwriting is just for you to be able to put in your offer, right? Your due diligence is where you're going to get all the underwriting, and you're going to redo that again with the correct information that you got from the seller. Because here, you might have, for example, just what the guy told you on the phone, something, a piece of paper at mobile home parks. If you're buying from mom and pops, which is, just get ready for it, is sheet of paper. So John lives on 2, $300, and he'll write you and send it to you and be like, hey, I paid this much money for this much money for that. And they're going to give you some of these expenses. And then when you're doing due diligence, you're going to ask them to formally send you some more documents. Now, it might get better. It might go on Excel, or it might be more pieces of paper, but with more detail. Okay. So just be prepared.
I'm laughing. Yeah, I'm laughing because one of the first mobile home park, by the way, William Hollis says he wants, name the price on your spreadsheet. He wants one. But one of the first mobile home parks I looked at, I asked for a rent roll. And like you, I had been in the multifamily space, and and I'm like, all right, let me see the rent roll. I literally got handed a 8.5 by 11 white piece of paper where somebody had taken a pencil and drawn rectangles, out the layout of the park and numbered them. And then on the right-hand side was the legend of that number. It wasn't names. It was just what they were supposed to pay per month. And I was like, what is this? And they're like, that's your rent roll, and that's our financials. Don't ask us for anything else. And I was like, okay, I'm done. We'll see you. Hey, I got a question for you on market research. Since there is limited things, and that park that we talked about last night in the mastermind call, one of the things that I did, and I guess I'm asking if there's a different way to do this, but I looked up the 2 parks that were adjacent to the one that we underwrote, and I called them, and I acted like I was, now this park is in Alabama. And for those of you who don't know, I'm from Northeast Alabama. So when I'm around Alabamians, the country drawl comes out and the country slang comes out. So I really poured it on and made it, acted like I was a potential tenant. And that's how I got to know exactly what those adjacent parks were charging, their availability, and that sort of thing. Is there a better way to do it than that? Because I kind of felt like I was lying, although I don't know. Maybe Cassie's going to kick me out and I got to find some place to live, but
honestly, there's not one better way. So, and I've gone both ways. So I actually have gone to some, where I will call and pretend to be somebody interested in leasing. And then I've also called some where, and usually the ones that are full, because they'll say like, oh, we're full, we don't have any space. So then won't tell you any more information, even though you ask. So what I'll say is I'll call back again from a different number and just say like, hey, I'm buying a park in the area. I'm trying to learn a little bit more about the market. I'm a little new. Do you mind sharing like what you guys are renting it for, if you're full or not? And to be honest, the mobile home park industry, from my experience, bar to none, is the most, friendly industry out there. Yeah, I'm not about transparent. Transparency can go in different layers, but they're very helpful. Okay, so they will like tell you, if you just want to know, super helpful. Like when I was starting cold calling, right? Part of it's doing some market research as well. When I was looking for properties, right? And so I always tell them like, hey, what how long you own the park and stuff. And sometimes I'll stay on the phone with these owners for like 20 minutes, and they're telling me the life story as to how they got the park, and some people to talk to if you ever need moving service. They're super friendly, super helpful, for the most part, right? You always have your a-holes everywhere, but but most part they're very friendly. So if you go with that approach too, most of the time they'll be fine. And sometimes they'll even know, if it's a small city, they'll know who the owner was. It's like, oh, so you buying Jimmy's Park, whatever? I was like, yeah,
That's funny.
that kind of stuff. So one more thing about that too, since we are on the topic, is the third way to go about, and this is what you do more when you're in due diligence, is test ads, right? So you would get, which is also, if you feel like you're lying when you're asking for the rent, this is like super lying, right?
I don't know. I
You'll run a test ad. So you get a picture of a mobile home.
I feel like I was lying, and I need to ask for forgiveness. Actually, should I call? I should call those parks back and say, "Hey, you remember when we talked? I was totally lying. I was scoping you guys out to see because we're looking to buy this property over here."
So what you do is you get a picture of a mobile home, kind of similar to the ones you're going to have there, and basically kind of advertise that mobile home for rent. And you want to see the demand, and then you're going to advertise a similar mobile home for sale, and then you kind of see what your demand is to buy, to rent, what people are willing to pay. Because like I mentioned to you last night, part of the underwriting pro forma is if you have rentals in your park, right? Those are the easiest ones to reset to market rate, right? As long as they're paying above what the lot rent should be, right? So if they're paying $600 in the lot rent for the home total, and the lot rent is $300 in the market, right? And right now the people that are paying lot rent are paying $130. That's like, you just like literally shuffling paper, and you can on your property management
P&L
software, whatever the P&L property management software, you just divide $300 lot rent, $300 home rent, and then that way it will show in your P&L those two being separate, which is very important part of underwriting, because banks don't give any or very little credits to income above lot rent for mobile home parks. So very important to understand this. Banks sees mobile home parks as a land lease business. Now, I'm also going to say this, is that if you're running the park and home model, you're going to have to find the right bank that's willing to finance you as an apartment complex, and they're going to collateralize everything. And so if you decide to ever want to sell one of these mobile homes, you're not going to get this cash from the sale, because it's going to go, you have to ask for permission from the bank. The reason why most banks do only land lease is because if you want whatever you want to do with those homes, it doesn't affect their loan, right? So you can sell, you can move it, you can whatever, it doesn't affect the loan. You don't have to ask for permission for anything. So it makes it simpler for them. So that's where you, very important when you're underwriting is, don't give too much credit. So how do I put this? So you're going to give credit for yourself, because that's real money that you're collecting, but you're not going to give credit on the cap rate to get the loan from the bank, because the bank might not give you that credit. Does that make sense? So you're going to subtract out, and that's why I'm going to perform with the underwriting spreadsheet, which I'm going to go over in a bit, is going to explain that. So I don't know, how much time do I have, Jake?
You've got 7 minutes. You want to jump to the spreadsheet just to give?
So you can see, this is a little taste of, I have like one that's quicker. So just to give you an example, right? So this is the 5-minute underwriting spreadsheet. And this is kind of like a good, determining factor. It doesn't apply for all the other income from the lot. So let's say, for example, this is actually a park that I was underwriting. So they're asking $2 million. Their average lot rent is actually not $625. This is the combined. So their average lot rent there is $350. They have 55 total lots. 44 of them are occupied. Here I put kind of what my expense ratio would be for that size of park. I like to put like 40%, right? 30% down payment. Loans you're looking at, typically I underwrite at 70%, but it'll be 65 to 75 depending on the bank, depending on the asset. So just keep that in mind. So I always like to do 7%. one thing that I want to touch and drive the point here on this is that interest rates. If you're buying smaller parks, where loan amounts are below $2 million or even $1.5 million, you're going to use local banks. Okay. And local banks right now, they're not giving you exact interest rates because interest rates are varying all the time. And so they'll give you their 5-year treasury rate plus their, what their profit is. And then whenever you lock it, it's going to be where you do. So if you go to the treasury website, you can see what the treasury rate is, and you can kind of start, as you're underwriting, you're looking at, okay, where am I at right now? And what does I see as a pattern that's going to be? So right now, if I'm looking at, I'm at 5.5, but I'm seeing the pattern that's going up. So I'm underwriting for 45 days out, right? Because that's when I'm probably going to lock that rate. So I'm underwriting a little bit higher the interest rates. And if I get cheaper interest rates, it's a win, right? This is if you're using banks. If you're using seller finance, doesn't matter too much. That's whatever you agree.
Hey, Victor, since we're running short on time,
Sure.
and I want to, since we're talking about underwriting and potential pitfalls when underwriting, can we scroll through just the different tabs, like, the executive summary? Because this is the napkin test, right? The executive summary, there's this particular tab pulls a lot of stuff from your other tabs. Is it these scenarios or the no-fill pro forma that you get into?
No pro forma. Yeah. So this is kind of like, so if you look at this is like your general idea of like the numbers. So the purchase information, right? Here's important: cap rates when you refinance, cap rates when you sell. Here gives you like your year one pro forma analysis. And again, it's not fully, I did the underwriting outside. Yeah.
If it is, that's a really horrible deal. You should run away.
So you see your net income. And here's the point that I was explaining to you guys. So it has the park-owned home income separated from the lot rental income, because that's going to be under scenarios, which you're going to see here. It's going to be your purchase for property only, right? So if you're buying notes, because there's a lot of times you buy the park with the notes, or if you're buying the mobile homes, it will subtract that. So it gives you your purchase for the lots only. And that's what's going to derive your loan amounts from for your first mortgage. Now, here's the other thing on the bottom here that I want to kind of go is the cap rate on the lots only. Because here's what you need to be watching out for, because that's what your bank is going to evaluate it at. Some banks, like I said, might give some credit for the park-owned homes, but not much. And so that's why it's important for you just evaluate the cap rate slot only, and then look at the cash on full operations, right? And so just to dive in on this little pro forma thing here, is you'll see how you have, where is it? What we're talking about. So cap rate. So you can see here on the bottom, you'll have lots only income, all operations income, and then you're going to have the cap rates based on whatever 9, 8, 7, and then basically you can see the valuations of that property throughout the years whenever you're working on those. So it's very important to kind of like understand that your cash flow might be bigger. If we had more time, I could have pulled another spreadsheet, but your cash flow might be bigger if you have park-owned homes or you have notes, but your valuation when you're looking at a bank refinance is going to be lower because that income is not going to be showing there. So your cash on cash might be really high, but your equity on the property's eye, on the bank's eye, might not be as high as that. So just always keep that in mind as well. So but that's that for this. So yeah, there's a lot of nuances, but I think those are the points that I wanted to drive: is understand what your exit is, understand your financing, and know your market, because that's where you're going to be going after. So
Yeah, and one of the things last night that we were talking about is, the park that we're looking at. The current owner, I've never heard of anybody doing this before, but he has not all, a good majority are tenant-owned homes. It's a very small park. It's like 18 units or 18 pads. For easy math, 15 of those are parked-owned homes. 3 of them are tenant-owned homes, and he's wanting to transition to them all being tenant-owned homes, right? So he underwrote it, and I think that's where he got his asking price that he's asking now to sell it. But if we go back and we look at what our strategy would be to convert those remaining to all park-owned homes and just rent out the dirt, all tenant-owned homes and just rent out the dirt, it dramatically changes the numbers, right? To the point where, Jamie and I left that conversation last night, like, probably not going to do it. Or we've got to get super aggressive with a not highly motivated seller to, get him to change his mind on what he's asking and whatnot. So, you got to know that strategy going in, because it can extremely push the numbers one way or another, right?
100%. Yeah. That's all it is, because, if you know what model you're going after and how long you're going to hold it for, because to your point, we were talking about is those first 2 years for that park sucked really bad,
Yeah.
But,
yeah.
We
didn't,
but after that, if you go like 3 years, 3 to 10, it was great. It was a great property, but you had to hit certain numbers, and, you also had to, be okay with basically like
funding the park for,
years.
there were some capital calls that were going to happen.
Yeah, exactly.
Years 1 and 3, and we're just not in that business. We're not the buyer if that's the price, and that part does not fit our strategy, and we got to have the courage to step away from it. So
100%.
Victor, we're out of time. I want to make sure people know how to get in touch with you. So if you want to drop that in the chat, because guys, I want to tell you, last night it was fundamentally amazing to go through and spend some time with you and go through that spreadsheet and look at this real-time park, because we've already submitted an LOI on the park because we underwrote it the way we knew how to, and it was a good deal, man. It was going to be great. And I'm telling you, after last night spending some time with you saved us some heartache and pain. So
happy to help always. So thank you guys for
Begins with a thought, an idea that keeps growing in your mind. You spend days, months, or even years just simply thinking about it. There are many ways to get started, take action, and make progress, but both you and I know the best way is to have a guide as you surround yourself with like-minded people. Peers who are on your level that are actively taking the next step. You'll feel empowered, and your competence will breed confidence. Having so many options to choose from when purchasing a real estate investing educational program, you'll soon find out that just a few will understand your thoughts, your fears, and your expectations. For the next 6 weeks, I will be your coach. Grasp your vision, create realistic goals, and diligently apply what I've learned from investing since 2014, and deliver a framework for you to build your experience and portfolio. Seating is limited. Register today.